Sorry about that. So you've got your permanent piece where you essentially have a minimum level of current assets that you need to be able to function. That could be financed with either long-term or short-term debt. And then you got temporary. Temporary is the one that is really fluctuating based upon seasons. So if you've got a winter sports type business or a summer sports type business, and you have skis or you have water skis or snow skis, you're probably going to need to have a buildup in inventory ahead of the season so that you have stuff to be able to sell. Then when you're off season, you liquidate your inventory, which is why you see sales of summer products in August and September, because they want to get rid of them before winter so they don't have to carry inventory through the winter. And again, we talked about some of the costs of carrying inventory, which included storage costs and included things like shrinkage, which is inventory walking away. But what other cost is there associated with inventory that tends to be one of the largest costs that we don't think about? Inventory obsolescence. So essentially you have seasonal inventory, and that inventory, whether it's equipment, whether it's technology, whether it's clothing or other retail items, tend to have not only seasons as far as winter, summer, but they also tend to be this year's fashion versus last year's fashion, or this year's technology versus last year's technology. And inventory obsolescence is a major cost of carrying significant inventory. So you want to keep your inventory levels as low as possible. There's three real common approaches to managing your current asset financing. Because again, at the end of the day, you're either going to finance it with long-term debt, with retained earnings, or with short-term debt. You've got a maturity matching approach, and we're going to talk through each one of these in detail. Maturity matching, a conservative approach, which essentially gives you quite a bit of cushion, and an aggressive approach, which will maximize your profit, but if you're wrong, you're going to run out of cash. And so you've essentially got these three: the middle, the conservative, and the aggressive. Each one corresponds to the optimal profit, but of course, for profit to be higher, what are you trading off? Risk. So you want higher profits, you take more risk. You want lower profits, you have less risk. And what you're going to see is this holds true. There's no such thing as something for nothing in finance. There's no such thing as being able to get a really high return without it being really risky, as long as you assume the markets are reasonably efficient. So here's maturity matching. Maturity matching is essentially the methodology that most companies use to be able to manage their working capital. It says we match the maturities for the liabilities with the maturities of the assets. Essentially, we take our collection of accounts receivable, that folds into paying our payables. We take our conversion of inventory and sales, and that turns into essentially the cash that we need to be able to make payroll. We look at how long it's going to take to collect these things, and then we time out the payments of our payables such that the two match up. If you are able to do this, and it's difficult because not everybody pays on time. Your payroll, we talked here at the university, we pay once a month, which makes it, if we got paid every 30 days, that would be okay. However, as we talked about last class, we get paid twice a year. Essentially, the university gets paid twice a year, once in October and then once in February. And so doing a maturity matching for us would be pretty difficult because our receivables come in twice a year. We have about 140 days between those two collection periods, and then about 180 days between, or almost 200 days between the February and the fall. So we can't do maturity matching here. Firms that can do it, however, where you've got a relatively quick cash turnover cycle and you can manage your payables appropriately, are able to use this without having a significant amount of additional financing costs. As noted, some assets' lives are uncertain. You never know exactly when you're going to get paid and exactly when your sales are going to happen. Every once in a while in your sales or your inventory, whether that's going to be finished goods or whether that's work in process services. So some of this is a little bit of a guessing game, and the way that you manage the guessing game on that side is you speed or slow payables on the other side. And as I mentioned, this is a moderate approach. This is the not too hot, not too cold, just right forage of working capital management. And it looks essentially like this. You've got your fixed assets tend to be financed with long-term debt. You essentially match the maturity of the asset. So you've got an asset that's going to be alive for 25, 30 years or 10 years or 5 years. And you purchase it with debt that's essentially got the same life. So that you've matched the cash flows from the asset with the debt service for the asset, and you use long-term debt or equity to finance your fixed assets. When you look at your permanent level of current assets, so you need to have a certain amount of money that's just dealing with your float, cash in, cash out, being able to pay bills here and there, you can finance that with long-term debt and equity, and what they call here spontaneous current liabilities, which is nothing more than slowing your payables down. You can create spontaneous liabilities by not paying a bill. And all of a sudden, you've now created a liability where before it just would have been a cash expense. Then this temporary current assets piece is the portion that you need to manage because you've got fluctuation in seasons, or you've got fluctuation in required inventory levels or production levels or stuff like that. And this, again, is where you use your short-term, what they call non-spontaneous debt financing. What financing is slowing down liabilities or slowing down payment of payables. What do you think non-spontaneous debt financing is? Anybody want to hazard a guess?
How you would facilitate trying to pay people as slow as possible.
That's spontaneous. Nope.
Yeah, as soon as you get your bills.
Nope. That's all. What you guys are talking are all spontaneous current liability management. Yes, sir. You're closer. Closer.
Line of credit.
Line of credit. So there you go. Sebastian, way to go, baby. So there we go. So what you've got here is you essentially start managing you manage your payables up and down, right? And you go, okay, I'm going to slow these guys down. I'm going to speed these guys up. This part, non-spontaneous, means, hey, I know I'm going to need this. I set up a line of credit. And I draw the line of credit when I need additional cash. And then when I sell that inventory off, I pay the line of credit back down to zero. And then when I need the additional cash again to be able to build inventories or be able to pay additional payroll, then I draw the line of credit down. So you can anticipate it. It's the same way that most of us would operate. And that's why as you started getting into things like, structuring your payments and prepaid taxes and other things, it's the way that some of us work in our lives where we go, okay, we've got a mortgage and we've got to be able to get through, our spending money. And so if we're a little short, we got more month than money, we might slow down some of the payments. And if we got more money than month, we might be able to save a little bit. That's your spontaneous piece. But if we know that we're going to need some additional money and we're going to then pay it off, we use things like our tax refunds, or we use things like our credit cards, and we go, okay, I'm going to charge this. I know I'm going to be able to pay it off in 2 or 3 months, so I'm going to charge it. I'm going to pay interest for a couple months, and I'm going to pay it down. And this is your business lines of credit. So business lines of credit are not designed under this scenario to be financed with, or your short-term fluctuations are not designed to be financed with your permanent capital. And they're not designed to be essentially financed with your equity. Your fluctuations are financed with short-term debt. So you've essentially matched that short-term volatility in your need for current assets with debt that kind of follows along, and that's the maturity matching principle. And again, if you look at the spontaneous current liabilities, that's where most of us were going, and that's what we talked about last class, where you slow down your payables when you run out of money. Financing. You've got some alternative methodologies, a conservative approach. Most companies don't use a conservative approach because it costs money. And many companies, just like many people, live pretty much paycheck to paycheck and don't have wads of cash lying around, especially if they're small, mid-sized businesses. Small, mid-sized businesses, even if they do generate quite a bit of cash, tend to then pay that cash out to ownership. Don't leave a ton of cash sitting in the business. So what they do is they use long-term capital to finance all permanent assets and some seasonal and temporary needs. So essentially, what you're going to find with companies that use this methodology is they've taken on long-term debt. It's like taking on a mortgage. And you take out a mortgage for your house, and you go, okay, the house, I'm going to need to borrow $400,000. I'm going to borrow $450,000. I'm going to put the other $50,000 in the savings account, just in case. Now, you're going to end up paying interest on that debt. It's going to be less than the income likely that you're going to get off putting the money in the savings account, but you're never going to worry that you don't have enough money to be able to cover up something that's going to be unanticipated. And so you've used essentially long-term capital to finance some short-term liabilities. You've used spontaneous short-term debt to finance the rest of the temporary assets, your seasonal needs. You store liquidity, you put money in a savings account during the off season, and then when you get to the on season and you need it, you then hit the savings account and then you pay it back when your sales come in. And it tends to look like this. So unlike the others, you've essentially created this permanent net assets and temporary net assets. Or current assets. This is what you need to be able to finance yourself. Here's your fluctuation. You finance this piece all the way up to this dotted line with long-term financing or with equity. So you've reduced your requirements to actually borrow with non-spontaneous debt financing, which is what? Come on, I yelled it. Line of credit. So you've reduced your need to have lines of credit because you essentially are sitting on, at certain points in time, cash. So in this particular case, you're sitting on excess cash that you're just holding, and so you don't have to borrow until you hit this point, or before you'd have to borrow at this point. You save yourself a little bit of interest on the borrowing here, but you're paying interest all along on your long-term assets, or on your long-term liabilities. And so this is really a conservative approach, largely because in the event that there's a problem getting this last piece, you're not completely out of the woods and you don't have to make major changes or as large a change to your seasonality and your ability to deal with seasonal cash flow issues. The challenge with this is it tends to cost you more because you're paying interest on this, and then you're going to pay interest on this as well, where before you wouldn't have the interest payment on this unless you were actually drawing on it. And so as a result, you've got a little bit higher total interest rate, which means you've got a little bit lower ultimate return for your company. However, your risk level is lower. And so again, lower risk, lower return. And then there's the aggressive approach. Most small mid-sized businesses use the aggressive approach. The aggressive approach essentially says, we're going to finance all temporary assets with short-term spontaneous debt, finance fixed assets and some permanent assets with long-term non-spontaneous funds. It's the riskiest and it's the most profitable because in some cases you're not paying interest at all. You're borrowing money, you're slowing your payables down. You're borrowing at 0%, but you have very little in the way of excess cash sitting around to be able to ride through some of your issues. So in this case, your long-term financing, instead of being at this line, which it was in the first one, or this dashed line being up here, and we're financing a portion of our liabilities with long-term debt, our working capital with long-term debt. In this case, we're actually bringing it down. And we're saying, okay, when we start getting to the point where we need some additional cash in here, we're going to use our non-spontaneous debt financing. We're going to use things like lines of credit. We're going to use spontaneous current liabilities, such as slowing down our payables. And we're going to have the line of credit permanently drawn. Now, if we see anything that's going to be significant shifts in this, you're going to have difficulty extending your line of credit. You're essentially utilizing this short-term funding as your bridge to finance even permanent assets. However, because you're not sitting on excess cash and excess borrowing here, you're going to be down at a lower level of borrowing because your lines of credit tend to be low price but revolving. You're going to be able to save yourself a little bit of money on total interest, but you're also going to be in a position where you don't have as much in reserve. When you use short-term financing, essentially, as we talked about last class, accounting says it's things that are current assets and current liabilities are due and payable within a year, or are receivable within a year. As a practical matter, when you look at how we manage things in a business, it's normally 30 to 90 days. We tend to look at it a 30 to 90 day cycle, not a 1 year cycle. When you look at short-term financing, which are lines of credit, credit cards, factoring, which would be selling your receivables, you've got speed, because you have a line of credit. So in order to get a draw off your line of credit or your credit card, you don't have to walk into the bank, fill out a bunch of paperwork, get a loan approval. If you've got a credit card in your pocket and you want to borrow money, you walk into the store, you put down your credit card, they loan you the money on the spot. So you've got the ability to be able to get money quickly, normally instantaneously. If you're talking businesses and bank line of credit, it's almost as instantaneous as your credit card. You normally get on your online banking and you want an advance. They pull an advance off your line, they drop it in your checking account within seconds. If you're talking about a little bit more sophisticated line of credit where you've got it backed by an inventory borrowing base, or you've got it backed by a receivables borrowing base, which means you essentially report to the bank every month, here's how much I have in inventory, here's how much I have in receivables, and the bank says, I'll loan you up to 60% of that number. As long as you've got your reporting in for the last month, normally within 24 hours, you can get an advance off your line. Your cost on short-term debt is generally lower because the bank that you're getting your short-term debt from also has your cash account. So in the event you default, the first thing the bank will do is take all the cash that's in your checking account and pay off your line. And then if they can't get enough money there, they'll freeze your checking account. So any deposits you make, because your checking account, by the way, becomes collateral for your short-term line of credit. Banks will generally, by the way, try and get you to do all their banking services with them. So if they loan you money as a business, they also want your checking accounts, they want your payroll account, they want your credit cards, they want all that stuff. And for the most part, you're going, well, that's convenient, and they'll sell it to you as convenience. You're going to go, oh, this is convenient. You can have all your banking at one spot, and we can manage it for you. What the bank wants, however, is all your cash in one spot. And they want to be able to control you if they need to. And so if you are sitting in a situation where you are either an accountant or a finance person, or you're a business owner, I cannot stress enough that you should have at least 2 banking relationships, split your money, and make sure that you keep at least one bank happy, even if the other bank isn't. Because at the end of the day, what the bank is going to be looking at is if you start getting pottery, they're going to look at your credit cards to pull your credit cards. They're going to look at your line of credit to pull your line of credit. If you default on your line of credit, they'll freeze your bank account. They'll take all your cash. And so as a result, you really don't want to be in that situation. It's best to have 2 banking relationships, keep them both happy, they can both compete for your business. The risk of short-term debt, it's viewed as riskier because you're essentially using it to meet short-term obligations. And from your perspective, if you're relying on it heavily, like we saw in that second or the third aggressive approach, and the bank gets to the point where they say, hey, we're not comfortable with this, we're cutting off your line of credit. Normally, what you'll find is the bank, just like your credit card company, can turn you off right away. They can go, okay, you're done. We're not going to extend you any more credit. You have to pay off your line of credit. You're done. If you've got a term loan out there, as long as you're making your payments, they can't turn you off. And so from the company's perspective, short-term debt is riskier because your counterparty, the lender, has control over it and generally can change it on a day-to-day basis depending on what side of the bed they wake up on. So again, from your perspective as business owners or as financial managers, you want to try and negotiate out things like 30 or 60-day notice before they terminate unless you're in default. You want to be able to negotiate out terms that allow them, if they do stop this, to turn it into a term loan so that it doesn't call it right away, which means you have to pay it all off right away. But there's a lot of risk associated with these short-term liabilities if you're the business. Again, if you think about it from a personal perspective, if everything you do is running through your credit card and you're relying on that credit card in order to be able to survive, and your credit card company decides that they're going to stop advancing you money because you've been late on a payment or they don't feel really comfortable with you anymore based on your credit score, you've got a problem. As opposed to if you had a savings account sitting there and you were able to kind of use that savings account. So it's the same thing with a business, and the banks are no different. As a matter of fact, I would argue with businesses, the banks can tend to be a little bit more difficult to work with. You've got a couple sources of short-term financing. The first one is accruals. Accrued payroll is a big one. Accrued other short-term liabilities like payables down here are another. So you've got payroll, taxes, and payables, where these are things where the longer you take to pay them, the more cash you have available. So payables, we talked about, that's generally, there's trade payables, which are essentially you with another company. Your accruals here, wages and taxes, are amounts due to your employees, to the IRS, and in the state of Washington, to the state of Washington Department of Revenue. I've said it before, and I'll reiterate it. The one vendor you do not want to extend past any due date is your tax entity. The IRS and the Department of Revenue are unforgiving SOBs who will put you into bankruptcy faster than anybody else, seize your assets quicker than anybody else, be able to drop massive penalties, fines, and interest on you faster than anybody else, and you can't discharge tax obligations generally in bankruptcy. And so if you're trying to restructure a company, which again, that's more my background, taxes are one of those things that you gotta pay. And unfortunately, if you walk into a company and you're in a turnaround situation, the thing that tends to get paid almost last is taxes, because the government doesn't kind of go, oh, you forgot to deposit your payroll tax withholding this week. What most business owners do in practice is they pay people's wages because they don't want the employees to know everything's going to heck in a handbasket. But they don't pay the amount of money that's been withheld from your check for FICA, for federal tax, for state unemployment, for L&I, for those things. They kind of hold on that because L&I doesn't call right away, and the IRS doesn't call right away. But when they do call, it's really bad. And you can go to jail. Now, most of these other ones, you can't go to jail. The IRS, you can go to jail. And if you're the person responsible for making those payments, you're considered by law a trustee for the IRS. So if you hold the money, if you withhold the money from someone's paycheck, you are now a trustee for the IRS, because that's the IRS's money. It's not your money. You took it from one of your employees. And so if you don't remit that money to the IRS within the specified timeline, the IRS said you stole the money. You can't steal the IRS's money. They'll send you to jail. So the one thing that you should never do is stretch your taxes. Pay them timely. It will only come back to bite you in the tail. Wages, generally you can't stretch those either. The university does it by paying once a month. You normally can't pay at an extension longer than once a month. Employees really won't go multi-months without a paycheck. Once a month is about as far as you can stretch it out. Where you have opportunity to stretch out your payments on the accrual side of the ledger and the accounts payable side of the ledger, the spontaneous side of the ledger is really in the accounts payable. Any questions on that? Because I can't emphasize enough that taxes are not one of the things that you should be kind of slowing down and deferring, especially payroll taxes or sales tax remittances or B&O tax remittances, business and occupation tax here in Washington. Okay, good. Short-term bank loans. They're generally a 90-day or less bank loan. They're designed to carry you through a season. And so essentially, there's going to be a promissory note, which is a set of loan documents that says, here's what we're going to loan you. Here's what you need to do. There's going to be conditions called covenants, which say during the course that this loan is outstanding, you need to maintain a net income of X, you need to maintain a compensating balance or cash in your account of Y. You need to report to us collateral, and normally there's always going to be collateral. By the way, the banks will look for multiple sources of repayment. You'll hear this when you talk to a bank. They go, we need multiple sources of repayment. So multiple source number one is your business cash flow. Multiple source number two is collateral, and that collateral is going to be business collateral, which is generally going to be, in this particular case, when you're talking about short-term lines of credit or short-term bank loans, it's going to be accounts receivable and inventory. Essentially, they're saying, okay, you're borrowing this to build inventory in order to go through a season. And so we're going to make you give us this inventory borrowing base. So as you make $1 million worth of inventory, we'll lend you $600,000. As your inventory gets sold, that inventory number comes down, your borrowing base comes down, and you have to repay the loan. So they basically force the loan repayment based upon inventory by extending you collateral based upon a percentage of your underlying inventory or accounts receivable. And then you've got the third source of repayment. So if they can't get it from your business cash flow, and they can't get it from the collateral, even though they've only probably advanced you 60% or 65% of your underlying, where do you think that third source of repayment is?
Your personal.
Your personal cash flow. So if you're a small business owner, or even a mid-sized business owner, in many cases, the bank will require you to sign a personal guarantee, which essentially says, look, we're going to, if you default on this loan, we're going to seize the collateral, we're going to sue the business for a deficiency and sue you at the same time. And we're going to take your house, and we're going to take your car, we're going to take your kids, and we're going to take everything.
You can take the kids.
Well, I might try and trade them. But essentially what they're looking for is to hold the owner's feet to the fire. Essentially going, look, if you're a majority owner in this business, or you're a substantial owner in this business, or a significant manager in the business, we don't want you going, okay, straight, I'm walking away. The bank wants their money. And so they're going, look, we're gonna not only seize collateral, but we're also gonna come after you personally. And if you're smart and capable, the first thing you should do, if you're the business owner or if you're the CFO working for a business owner, is negotiate that personal guarantee away, because you don't want to be on the hook for your business's failure, nor do you want your boss to be on the hook if you're in the situation to do it. And you'll make your boss so incredibly happy that you've made her or his personal guarantee go away. So focus on, remember, banks look for multiple sources of repayment, generally 3 or more. They're going to look for collateral, they're going to look for business cash flow, and then they're going to look to your cash flow. And so to the extent you can get rid of that third stream of potential repayment, you're going to be in a better position. Bank loans tend to require compensating balances. I talked about this, kind of mentioned it in passing. A compensating balance has the effect of making your interest rate higher. And here's why. The bank goes, okay, we're going to loan you $600,000 against your $1 million of collateral. So you got $1 million worth of receivables. We're going to loan you $600,000 against that. And you have to maintain a compensating balance of 10%. And that 10% needs to be in a savings account at our bank. So how much did they really loan you? $540. How much are you paying interest on? $600. And if you default on the loan, what is the bank going to take? They're going to take $600. They're going to take the $60 that's sitting compensating balance. Then they're going to foreclose the collateral. Then they're going to hit you. Then they're going to sue the business, and they're going to sue you, and they're going to take your cash flow, to the extent that your collateral can't liquidate high enough to be able to cover the advance. So that's something to just keep in mind. Compensating balance, when you're calculating out the effective interest rate or the effective cost of a bank loan or a bank line, remember compensating balance. Remember that you don't get to use all the money, but you're paying interest on all the money. And so you have to factor that cost in when you figure out the effective rate and also how much you need to borrow. Because if you need $600 and the bank's going to require you to maintain a compensating balance of 10%, you actually need to borrow like $670 to be able to then have $603,000 in the bank to be able to get through your compensating balance requirements. You've got lines of credit. We've been talking about lines of credit. This is more what we talk about in the bank loans, tend to be more of there's term loans, and there's lines of credit. Lines of credit act similar to a credit card. You essentially go, okay, we're setting it on a revolving line. Revolving lines can operate in two different ways. You can have a revolving line which essentially says, okay, I'm going to specify when I get money off the revolving line of credit and put it in my checking account, and I will specify when we repay it, similar to how you'd operate your personal credit card. There's also revolving lines of credit which are daily revolving against your checking account. And we're going to talk about that in a couple minutes, maybe not today, maybe on Monday. But they're called ZBAs, zero balance accounts. And what the bank does is you have a checking account, and the checking account has $0 in it all the time. You write checks on the checking account, the checks come in to the bank, it overdraws the zero balance account. The bank then automatically takes a draw off the line of credit to cover the checks. If you have more deposits for that day than you actually have checks clearing, the bank takes the money that's in that checking account and puts it and reduces the balance of the line of credit. So it's like making a credit card advance or repayment, depending on the net transactions in the account, every day. And at the end of the day, the checking account always reads zero. If the line of credit is zero and you have cash available, then either the bank account will go to zero and they'll sweep the money over to a savings account, or they'll allow the cash balance to begin to grow. So these zero balance accounts tend to be pretty popular with banks because they really control then your checking account, not just on a, we're going to come in and seize it after 24, 48 hours, give you a chance to cure. They have their money sweeping against their credit every day. And you're taking advances every day. And they charge you for that. So you've got fees, transaction fees, going each direction. Additionally, there's more fees. So one of my favorite banks in the world is Wells Fargo. And Wells Fargo is a great bank because they will charge you a fee for everything. And they're not alone. Banks make as much money or more in fees as they do in net interest margin. And when you study money in banking, you're going to realize that banking has become more of a fee-based business and a consumer-based business than a traditional business interest business. Between checking account fees and transaction fees and compensating balance fees and FDIC fees, commitment fees, loan fees, and other fees, you're going to be, if you're a banker, you love fee income. Commitment fees. Commitment fees, if you read this, it's the fee charged on the unused balance of a revolving line of credit. So what does that sound like?
They're charging you for that.
Yeah, you're getting charged interest on what you're not using. So you not only get charged interest on what you are using, you get charged a different rate, which they call a fee, but it's really interest on what you're not using. Because the bank's committed that money to you. So you can draw it out at a moment's notice. And so if you have a $1 million line of credit and you've drawn $600,000, you're going to pay the interest rate on $600,000, and you're going to pay the commitment fee on the outstanding balance of $400,000, or the non-outstanding balance but available of $400,000. The commitment fee might be 1 or 2%. The interest rate on the other might be 3 or 4%. So your effective interest rate is closer to 3.5 to 4%, as opposed to, well, I've only got, it's only 4% on a piece that's outstanding. So when you're setting up bank lines of credit, take a look at the fees. The other thing that is not on my slide is the bank will then charge you other fees. They'll charge you a fee to set it up, so it'll be a loan fee. There'll be an underwriting fee. There'll be a documentation fee. There'll be a UCC filing fee, which is a Uniform Commercial Code filing fee, which allows them to essentially, it's like when you get your title for your car and it says, the bank, and you get your registration, it says the bank owns your car. Essentially, it's the legal owner. For businesses, you don't have titles. You do for your vehicles, but you don't have titles for your other assets. So the bank files this thing called a UCC-1. And a UCC-1 is a little piece of paper that they file with the Secretary of State's office down here in Olympia that says, Wells Fargo has a first lien interest in all my accounts receivable, signed business owner, Wells Fargo. And so you're going to have a fee for that too. You're going to have a legal fee associated with drawing up the loan documents. You're going to have fees everywhere. So as you're looking at bank financing, whether it's short-term financing, long-term financing, bonds, remember I said there's flotation costs with bonds, we just don't talk about them in here. There's fees and other costs associated with setting up lines of credit and term loans at banks and SBA loans and other things that we don't really factor in when we're doing calculations. But you as business folks need to understand that they're in there. It's kind of like Ragu that's in there. And you're going to have plenty of fees to deal with. And so when you're looking at the cost of borrowing and the cost of setting up these lines of credit, make sure you understand the total cost. Make sure you understand not only the interest rate, but also the underlying fees, the commitment fees, and the costs associated with getting those things set up. Any questions? All right, I will see you all on Monday. Have a great weekend.